Okay, chapter one, we are talking about businesses' needs to invest in other corporations and why do they do it. So there's a variety of reasons. I mean, it could be just to simply invest. They have idle funds and they want to earn some money in the stock market. So again, that's just the same reason that, individuals invest in stocks of a company. But more often than not, it's number two or number three. They're trying to gain influence over another company. So say it's their supplier and they want to kind of exert extra influence on that supplier. So maybe get their products first, get their jobs done at top priority. Or maybe it could be their customer, so they're going to purchase or control part of that customer stock so that they can say, hey, put our stuff on the top, the middle shelf so it gets the most eye contact, or out by the, cashier's registers where people are going to grab it. So again, just something that you can somehow kind of push your product out the door. Or ultimately, once you are gaining influence, you could keep acquiring more and more stock so that you end up actually acquiring the company. And you may want to do that to go into new geographic market areas. Sometimes that's the easier way. So say you operate in the northeastern United States and you want to go out into the Midwest. Well, acquiring a company that's doing the same thing that you're doing, but in that region, all of a sudden opens that door, and then now you are operating in that region without having to compete with them or to, start up your own business and get your own customers. So there's three different types of methods that we follow generally accepted accounting principles. So it all goes back to that degree of influence. So if you have no influence, you're just playing the stock market, that's called the market method. And those you'll learn about in intermediate 2. You normally, or intermediate 1, one of the intermediate classes, and you will mark those investments up to market value, and you'll have unrealized gains or losses that you are going to funnel through either your income statement or your other comprehensive income. We're not going to get into that in this class, so that will kind of save for that class. But in this class, we're going to talk about these bottom two. So we're initially going to start with exercising significant influence, and then we're eventually going to control the company where we consolidate them into our financial statements. And we will use the equity method of accounting to account for those. So what are some indicators that we do represent significant influence over that investee company? So if we have representation on their board of directors, again, think about what the board of directors do. They kind of set the big picture for that company. If we are also involved in setting their policy and making their processes, again, we could have significant influence by doing that. If we had ownership percentages of our voting shares, so maybe say we've got 20%, and nobody else has that much. Everybody else has less than 1%. So our 20% is going to exert significant influence unless those other people join together to go against us. If there's material intercompany transactions between the investor and the investee, so again, we're buying and selling product to each other, but at a very material level. So maybe we're 60% of their business or something like that. If we are exchanging managerial personnel between the two companies, again, because the management controls a lot of the processes in a company, so that's going to be indicators of significant influence. Or technological dependency. So say we're using their servers or not just their software, but like their whole systems, and their employees are the ones who control our IT functions. That again could shut a company down. So that is going to exert significant influence. So we have two different types of business combinations that we will talk about. So one is just we're acquiring their net assets. So that's our acquisition method. So the companies may be up for sale, and we're going to go through them, and we're going to do our due diligence and see what their assets are, compared to their liabilities, see what their value is to us. Now, the difference between what they have on their books would have their cost. We are going to value it at fair value because we would be buying them. So we don't care what they historically paid for their assets. We're going to go out and have an appraiser come in and give us the fair value. Now, we could acquire them for more than their fair value of their assets. If that purchase price is more than the fair value of the assets, that creates an intangible asset called goodwill. So goodwill is the only way that can be recorded on our books is if we purchase it. So we can't self-create it and actually then give it value. So basically, it's something that we can't actually have as a separate asset. You'll see as we go through these problems, there are other different types of intangible assets that we do record, and we can assign value to them. But this is something like maybe they have excellent suppliers, they've got excellent employees, they have long-lasting relationships, a great reputation in the community, things that you can't really put a label on. So we're willing to pay more for that, and whatever that more is going to go into goodwill. So the net acquisition, when we are just acquiring the assets, it's just an asset acquisition, we're going to take all of their assets and put them on our books, and then the credit is going to be how much we paid. So this is saying we paid $380, or this was probably obviously in thousands, but $380, and we gave up shares of common stock at a market value of $50 a share, or $5 a share. Again, this is probably in thousands, but we'll just leave it in the dollars. So $5 a share. So we put in the $100 par value in our common stock, and anything over that into paid in capital. So 100 shares times the 5. So we gave up those, and we also gave up $380 in cash. We assumed their mortgage liability on their building, and then we received all of their assets. Then if you do the math of it, we would have a plug here of $80. So we're saying we paid $80 more than the fair market value of their assets less that debt. So that what we paid more for is going to go to goodwill. Now, we could in turn acquire all of their outstanding stock. So instead of the company like liquidating and we take all their assets and put them in our name, the company continues to exist. Now we just own all of them. So that is going to be what we do from chapter 2 and on. So chapter 1 is the only chapter that we have that net asset acquisition. The rest of them will be we're acquiring all of the stock, so it's $880, and then we gave up the $380 in cash, and we issued out the 100 shares at $5 a share. So you can see if I go back to this one, the credits are still the same. We still have that 380, the 100, and the 400. But then now all of the net assets, the assets less that mortgage, is all netted into this equity investment account. And that equity investment account will be on the investor's balance sheet, and you're going to see that we're going to adjust it then as time goes on, but initially it's going to be at the price that we paid to acquire all of the stock of the subsidiary company or the investee company. So then when we use equity method accounting, again, so here just recaps that same entry, we're going to put it into our equity investment at the time that we purchase it. And what we're doing is we're saying that that $800 that we show as the equity investment represents the net assets of that sub or that investee. So all of their assets less their mortgage is their equity. So the equity investment is exactly equal to the equity in the investee company. And then if we own them, as the year progresses, that investee is going to report income. So if we exert significant influence, generally accepted accounting principles, and following the equity method, we take our percentage of ownership times their net income, and we record a new line item called equity income on our parents' books. And then the offset to that is going to go to the equity investment. If the investee company then pays us dividends, that's like a return of that income. We already took our percentage of their net income and we recorded it. If they give us some cash back, we're going to receive the cash, and then we're going to credit our equity income or our equity investment account. We're not going to put it to dividend income because it's really not. It's a return of the income we already recorded in that first journal entry. So here is an example. Assume that the investee earns a profit of $300 and then pays a $100 dividend to the investor who owns 100% of them, again, just for simplicity. So we're going to record that equity income as a credit, we're the parent, and then we're going to add it in value to our equity investment. Then when they pay us the dividends, we receive the cash and we reduce that equity investment. So then if we're looking at our equity investment activity, we paid $800 to acquire this investee. We've recorded 100% of their income as our equity income, and then we've reduced it by the $100 they paid us back. So then our ending balance in our equity investment account is $1,000. Now then when we get into if we pay more than their book value, again, it could be that the fair market value of some of the assets that the subsidiary or the investee owns have gone up in value, or maybe they have intangible assets that we are going to record. So when we are recording those, we're going to record them at the fair market value. The investee company is going to keep them at their historical cost because they still exist as a legal entity. We are just upping ours because we paid for them. When we up them, though, we have to depreciate that extra value over time because, again, say it relates to that building may have gone up in value, but it's going to depreciate over time, so we have to record the depreciation on that extra value. So if the building had a book value of $600 and a fair value of $900, this extra $300 we are going to record on our books, and then we're going to also depreciate it. So the depreciation of $300 divided by the remaining useful life of 20 years, it's going to be an extra $15 a year. So then we would adjust our equity income by that $15. So again, we credited our equity income and we debited the equity investment. We would flip-flop that. So we would debit our equity income and credit the equity investment for that depreciation. So again, in that equity investment account, we are going to have the book value plus any of those additional assets that we purchased. And then this is, well, what if we are buying and selling between the investee companies? So if our investee sells $130 of goods to the investor, but the goods have a cost of $100, you can see they marked it up $30. So then our inventory that we hold is going to be marked up by that $30 difference. So like these would be the actual entries that the investor and the investee would make. We are going to debit the accounts receivable when we sell it if we're the investee company and record the sale, charge our cost of goods sold, and take it out of our inventory. Then the investor puts it into their inventory and sets up a payable. But again, the inventory is overstated by that $30. So that gross profit of that $30 is going to have to be deferred, and we're going to have to adjust that equity income. So that, too far. So then the required disclosures in the notes to the financial statements for a company that does have these equity investments, they need to list out each investee, what percentage of ownership they own. If it's those marketable securities, the ones where they don't exert influence, those they can just aggregate the value again because there's no specific reason they are investing in them. And then in there, if it's the equity investment, they have to also show the results of operations and basically the balance sheet of those investee companies if it's a material investment. So some of the criticisms to it is as you think about how I just said we value this equity investment, we're never really looking at it like we own 100% of their stock. We're never looking at it to say, well, what would that stock be worth if I went to sell it? We're really just looking at it from an operational standpoint. How much did we pay and how much of the income are we now recording? How much dividends did they give us back? And then when we're looking at the investor's income statement, it's going to have that equity income in there that does not represent necessarily any cash coming in. So again, because the investee company may not pay dividends, they may not pay that much of dividends, so then we'll have to adjust that when we get over to our cash flow statement when we have those type of investees. Okay, so that is chapter 1.